Yeah, well, obviously, AI has potential to influence economic growth for many years, but markets don't move in straight lines, and outcomes are never guaranteed.
Hello, everyone, and welcome to today's SWA Take 5. I'm Tendai. This is Jason. Today, Jason is going to help us look ahead in 2026 and look at the impact of things such as artificial intelligence, AI, the economy, and how current market conditions may affect you as an investor in this year. Jason, let's start at a high level. From an economic perspective, how is AI showing up?
Sure, AI is increasingly being viewed as a broad, general purpose technology similar to past innovations like electricity or the internet. And those technologies require significant upfront investment and took time before productivity benefits became truly visible across the economy. What we're seeing today is a large wave of investment in areas like software, data centers, energy infrastructure, semiconductors. And over time, that investment could support higher productivity and economic growth, though the timing and magnitude remain pretty uncertain.
Excellent. So these are meaningful potential innovations here, but also a wide range of possible outcomes. How does that translate into expectations for growth, inflation, interest rates?
Sure, well, current consensus seems to suggest that economic growth may remain pretty solid, supported in part by that ongoing huge investment in AI build out. At the same time, inflation pressures have become a little bit more persistent than many investors expected. So,
Yeah.
because of that combination, steady growth and inflation that remain, a little bit above the long-term targets,
Okay.
central banks, the Federal Reserve, may have limited flexibility to reduce interest rates, and interest rates may remain higher than what investors have become accustomed to during previous decades.
All right. So this obviously has implications across our portfolios. Let's talk a little bit about stocks, particularly U.S. growth and technology stocks, which have been front and center with this AI discussion. Maybe expand upon this for us a little bit.
It's a great question, Tendai.
Yeah.
In the near term, equity markets, especially growth-oriented and tech-heavy segments of the stock market, may continue to benefit from strong earnings and that ongoing robust investment activity we've been talking about. However, valuations in parts of the market are definitely elevated, and expectations for future earnings growth are high. And the thing to keep in mind there is historically, when expectations are elevated, markets become more sensitive to any sort of earnings disappointment. It's also important to remember that periods of strong technological innovation often bring increased competition,
Yeah.
higher capital spending, and a little bit greater volatility. And all these factors can weigh on long-term returns, even if the underlying technology proves transformative.
Okay. So let's dig a little deeper. Where might there be relative areas of opportunity within the markets today?
There's a couple areas that come to mind, and this is from a risk return perspective. So first would be investment grade bonds. So, we already talked about how interest rates might not be as low as some people as expected going forward. So now high quality bonds are giving decent income, especially versus the past couple of decades. Second, value oriented equities, particularly in sectors that may benefit from this AI productivity improvements, but don't carry the highest valuations today.
Gotcha.
And then third, developed international markets. Last year, international and emerging markets, stock markets were the big winners versus US. And this is where valuations are generally more moderate and long-term return expectations may be a little bit more balanced. So those are three areas.
Okay. And so this isn't about avoiding innovation, it's about diversification and valuation discipline, right? And so, Jason, as we wrap up, maybe what's the key message and takeaway for our listeners today?
Yeah, well, obviously, AI has the potential to influence economic growth for many years, but markets don't move in straight lines, and outcomes are never guaranteed. And so, rather than trying to predict which companies or technologies will dominate. A disciplined approach, diversified across asset classes, regions, and investment styles, can help manage uncertainty and support long-term investment objectives that investors have.
Yeah, that's great. Jason, always sage words of advice here around staying disciplined, staying focused on the process rather than headlines, right?
Yeah, I mean, exactly. That principle is as important as ever, Tendai.
Great. So, Jason, again, in a short amount of time, you've helped us really simplify the complex as we have an outlook for 2026. Again, for those watching, if you have any questions whatsoever, please reach out to myself, Jason, or anybody else here at the Salient Wealth Advisors team.